Welcome to House Lux Estate, where we empower you with knowledge to make informed investment decisions. Today we're going to take a fascinating journey into the domain of alternative investments. But wait, what are alternative investments, you ask? They are simply financial assets that don't fall into the conventional investment categories like stocks, bonds, or cash. Instead, they encompass a broad range of vehicles from real estate and commodities to hedge funds and private equity. In this era of financial evolution, they're rapidly becoming a crucial component in modern portfolios. But why is this the case? Well, they offer diversification, potential for higher returns, and can act as a buffer against market volatility. As we explore this topic further, we'll provide you with a robust understanding of their role and significance in contemporary investment strategies. So, stay tuned as we delve into the world of alternative investments and their role in modern portfolios. First off, let's demystify what we mean by alternative investments. When we talk about traditional investments, we're mostly referring to stocks and bonds. But the world of investing extends far beyond these two asset classes. Alternative investments represent a slice of the investment pie that includes a vast array of opportunities outside the traditional stock and bond markets. At the heart of alternative investments, we find categories like real estate, private equity, hedge funds, and commodities. Let's take a quick tour through these categories to better understand them. Real estate, for instance, is a tangible asset, something you can touch and feel. It's not just about buying a home. It includes commercial properties, rental properties, and even undeveloped land. Private equity, on the other hand, involves investing directly into companies that are not publicly traded on a stock exchange. This might mean buying out a company, injecting capital to help it grow, or taking a startup to the next level. Then we have hedge funds, a unique beast in the financial jungle. These are investment vehicles that pool capital from accredited individuals or institutional investors and employ a variety of strategies to earn active returns for their investors. Lastly, let's touch on commodities. These are basic goods that can be interchanged with other commodities of the same type. Think gold, oil, or even agricultural products like corn or wheat. But that's not all. The alternative investment universe also includes more exotic options like collectibles, cryptocurrencies, and even wine or fine art. These types of investments can offer unique benefits, but also come with their own set of risks and challenges. In essence, alternative investments are about diversification, about exploring opportunities beyond the traditional and venturing into the uncharted territories of the financial world. They can potentially offer higher returns, but they also come with a higher risk profile compared to traditional investments. Now that we know what alternative investments are, let's examine why they are becoming increasingly popular. So, why are alternative investments becoming a staple in modern portfolios? Well, the answer is as fascinating as the investments themselves. Alternative investments, which include assets like real estate, commodities, private equity, and hedge funds, play a crucial role in shaping the contours of today's investment landscape. One of the primary reasons that alternative investments are gaining traction is their potential to offer diversification. Traditional investments such as stocks and bonds often move in tandem, but alternative investments can provide a counterbalance, marching to the beat of their own drum. This means that when traditional markets are experiencing turbulence, alternative investments can often remain steady or even thrive, providing a safety net for your portfolio. But the benefits of alternative investments don't stop at diversification. They also play a pivotal role in risk management. You see, alternative investments often have a low correlation with traditional investments. This means that even if the stock market takes a nosedive, your alternative investments may not be affected, or could even increase in value. This unique characteristic helps smooth out the volatility of your portfolio, reducing overall risk. And let's not forget about the potential for higher returns. While it's true that alternative investments can come with higher upfront costs and may be more complex to manage, the potential for higher returns can make them a worthwhile addition. In fact, some alternative investments have the potential to outperform traditional investments, making them an enticing option for those willing to venture off the beaten path. So there you have it. Alternative investments, with their potential for diversification, risk management, and higher returns, are increasingly finding their place in modern portfolios. They offer a new avenue for growth and a buffer against market volatility, making them a compelling choice for today's savvy investors. But how much of your portfolio should be allocated to these investments? That's what we'll explore next. The question isn't whether you should include alternative investments in your portfolio, but rather, how much? As we delve into the allocation of alternative investments, it's essential to understand that this isn't a one-size-fits-all scenario. The allocation process is unique to each investor, taking into account several key factors. Firstly, consider your risk tolerance. This is the degree of variability in investment returns that you, as an investor, can withstand. If you're someone who can't lose sleep over the slight market fluctuations, allocating a higher percentage to alternative investments might not be the best move. On the other hand, if you're comfortable with risks and understand that high risk can lead to high returns, a greater allocation might be in order. Next, let's talk about investment goals. Are you investing for long-term growth, or are you more focused on income generation? Maybe it's a bit of both. Alternative investments can play a role in each of these scenarios, but the extent of that role will vary. For instance, if you're aiming for long-term growth, you might consider allocating more to venture capital or private equity. If steady income is your goal, real estate or infrastructure investments could be a better fit. Finally, consider your investment time horizon. The longer your time horizon, the more potential there is to recover from short-term losses, which makes riskier investments like alternatives more viable. Remember, alternative investments can be highly illiquid, meaning they can't be easily sold or exchanged for cash without a substantial loss in value. So, if you're planning to retire in a few years, you might want to limit your exposure to these types of assets. Now, allocation doesn't end at the decision of how much to invest. It's a continuous process that requires regular reviews and adjustments as market conditions change and as your personal and financial circumstances evolve. Now that we know how to allocate, let's look at some strategies to manage these investments. Managing alternative investments is just as important as choosing and allocating them. Think of it like a garden. You can't just plant seeds and walk away hoping for the best. You have to water the plants, protect them from pests, and prune them to encourage growth. The same holds true for your alternative investments. So, how do you manage these investments effectively? Firstly, regular portfolio reviews are crucial. Just like checking the health of your garden, you need to assess the performance of your investments regularly. Are they providing the returns you expected? If not, it might be time to reevaluate and make some changes. Staying informed about market trends is another important strategy. Just as a gardener needs to know about changing weather patterns, you need to keep an eye on fluctuations in the market. The financial world is dynamic and constantly evolving. Understanding these changes can help you make informed decisions about your investments. Lastly, don't be afraid to adjust your allocations as needed. If a particular investment isn't performing as expected, it may be wise to shift your focus to another. Similarly, if you spot a promising opportunity, you might want to increase your stake in that area. It's important to note that managing alternative investments isn't a set-it-and-forget-it kind of deal. It requires ongoing attention and adjustment. But don't let that intimidate you. With the right strategies and a proactive approach, you can steer your portfolio towards success. Remember, the goal of managing alternative investments is not just about maximizing returns. It's also about diversifying your portfolio, minimizing risk, and ultimately, achieving your financial goals. So, keep your eyes on the market, regularly review your portfolio, and don't hesitate to make adjustments when necessary. You're not just managing investments, you're cultivating a garden of financial growth. And there you have it, a comprehensive overview of how alternative investments fit into modern portfolios. As we wrap up, remember that alternative investments can be a powerful tool in your investment arsenal. Today, we've explored how they can offer unique opportunities for diversification, potential for higher returns, and a hedge against market volatility. We've also delved into the role they play in modern portfolios, providing a buffer against traditional market risks and often enhancing overall performance. Moreover, we've discussed how to allocate these investments effectively, considering factors like your risk tolerance, financial goals, and investment horizon. And we've considered the importance of managing these investments, from conducting due diligence to monitoring performance regularly. In essence, alternative investments can be a formidable component of a well-rounded portfolio, offering avenues to explore beyond the traditional stock and bond markets. Thank you for choosing House Lux Estate for your investment insights. Don't forget to subscribe for more informative content. Until next time, happy investing!